The head and shoulders pattern is one of the most studied reversal formations in technical analysis, and understanding how it actually forms is more useful than just memorizing the shape. It typically appears after an extended uptrend. Price pushes up to a peak, the left shoulder, then pulls back. It rallies again to a new higher peak, the head, then pulls back a second time. Finally, price rallies a third time but only reaches a peak near the height of the left shoulder, the right shoulder, before declining again. Connecting the two pullback lows creates the neckline, which can be flat, rising, or falling. Formation alone isn't confirmation. Volume tends to be highest on the left shoulder, lower on the head, and lower still on the right shoulder, showing fading buying pressure. The pattern is only considered valid once price closes decisively below the neckline, ideally with an increase in volume on the breakdown. A brief wick below the neckline that closes back above it does not count as a confirmed break. For traders studying this pattern, the theoretical framework usually involves waiting for that neckline close, and often waiting further for a retest of the neckline as new resistance before considering the pattern confirmed. Entering before that confirmation significantly increases the odds of getting caught in a false signal, since head and shoulders lookalikes are common in choppy markets and frequently fail to follow through. Risk management is central to how this pattern is studied. A stop loss is typically placed above the right shoulder, since a move back above that level invalidates the bearish reversal thesis. The measured move target is calculated by taking the distance from the head to the neckline and projecting that same distance downward from the breakout point. Though this is a rough guideline, not a guarantee of where price will actually go, it's worth being clear about the limitations. Head and shoulders patterns fail regularly, especially in strong trending markets or on low volume, thinly traded instruments where the pattern can look convincing without any real supply and demand shift behind it. Relying on the pattern in isolation, without considering the broader trend, volume, and market context, is one of the most common ways traders misuse it. The inverse version, inverse head and shoulders, mirrors this structure at the bottom of a downtrend and is used to study potential trend reversals to the upside using the same confirmation logic. This video is for educational purposes only. It does not constitute financial advice, and trading involves substantial risk of loss. Always do your own research and consider your own risk tolerance before making any trading decisions.